Financial reform finally passed by the Senate, an Obama victory on that front.
Obama has had two major victories, the one on healthcare and the one on financial reform. The markets didn't like the financial reform that much, though. They think that it will be bad for the profitability of banks, which they're probably right about, but it might be much more sustainable in the banking sector.
What about our banking sector? Is it likely to be affected?
Not really. Our banking sector has been very stable, so there's not much reform needed in our banking regulation.
The German finance minister said yesterday that he's convinced that the market is out of control and that we need effective regulation in the sense of creating a properly functioning market mechanism. But further regulation could hurt markets going forward.
I think that the German government is seen to be panicking a bit about the whole euro situation, about markets betting against specific countries and against the euro as a whole. So they are seen to not be cool, calm and collected, and that actually has contributed to market pressures. But what also happened in the Eurozone over the last 2 months is that the European Central Bank has been seen to support governments that are in fiscal trouble. So they've actually been buying bonds from Greece, Portugal, etc. And that has had a very negative effect on the perception of where the euro is going, because the perception is that the euro is no longer the bastion of anti-inflation, let's say, orthodoxy.
This week has been one of significant sell-off. Are we in for a market correction here?
I think we've seen the markets come down about 10%, which is pretty much the definition of a correction. So we've actually seen the correction. Whether that correction has further to go, whether it actually turns into a new bear market, probably has to do with whether the economy itself can sustain the strength that we saw in the first half of this year.
All right, sweeping bull on Wall Street, likely to affect markets as well as South Africa. But what is the bigger impact here?
Of the regulation in the US. What it basically says is that banks will be much more tightly controlled, and there will also be limits on things like salaries for management, bonuses, etc. So there's actually quite a significant change which will affect the sources of revenue the banks had before the crisis. So essentially the regulators are saying, you guys have been making profit out of things that are not sustainable, and we're not going to allow you to go another round on that.
And if we look at data out of the US, initial jobless claims fell, well, they increased it by 25,000 to 471 from, well, they had expected a fall to 440. The jobs market in the US still under pressure.
It is still under pressure. It's coming off the ground very slowly, and the reason for that seems to be that companies are actually still very skeptical about the strength of the upswing, and they are making do with the workers they've got. So on the other hand, one has to say that jobs are always a lagging indicator. So the economy gets going long before new jobs get created. But before you can really see the US consumer making a big contribution to the upswing, jobs need to come to the party. And that's what the worry is. The worry is that the consumers are still so indebted that they can't really push the next upswing. And then at the same time, in Europe, governments are being forced to cut back on spending and to raise taxes. So another source of demand disappearing there. So there's a significant fear that has come into the market in the last month, and I think that's what's mostly responsible for the 10% drop, that the upswing in the economy will not be nearly as strong as we thought maybe a month or two ago.
So an unemployment rate of 9.9% in the US, it was in April. Are we likely to see it increase going forward?
No, we're actually likely to see it sticking around that level, because what seems to be happening in the US is that discouraged workers who before were not actually looking for jobs have come back into the market and are now looking for jobs. So on their definition of unemployment, unemployment goes up, but that doesn't necessarily mean that there are fewer jobs.
And the US leading indicator slipped, however, to 0.1% last month. Analysts were looking at a 0.2% gain, the first drop since March 2008.
Again, these kind of numbers are actually fairly volatile, and we've seen them being very strong over the last year, and that's what's driven markets up. Now we're seeing that the kickback in the world economy that happened with restocking is now coming to an end, and we need more sustainable sources of demand to drive the US economy and the world economy forward, and that the worry is that there wouldn't be enough of this follow-through. One of the things that it implies is that interest rates will still stay very low for quite a long time, but the first thing that seems to be happening is fiscal retrenchment, meaning the huge amount of stimulus that governments have put into the economy is also being withdrawn. And the question is, is the world economy ready for that withdrawal? And that's why you're seeing all the markets that are predicated on very strong growth, like especially commodities, oil, etc. All of those markets have come under pressure.
Talking about global growth, we're seeing so much happening at this stage. Are we looking at it? Are we facing a double dip recession?
That's the real worry. That's why the markets are coming back. They are getting worried about that. My view is we're not. I think that there is, if you look at the fundamental factors, there's quite a lot of strength in the world economy going forward. But the future is always difficult to predict, and therefore a little bit of fear in the markets is maybe not a bad thing.